So again, just to address what we talked about on this last slide here, right? You're going to want to pay attention to the cost of goods sold and the gross profits when we look at the differences between these two different inventory valuation methodologies. There are several reasons, like I've said, several reasons why a company chooses to look at their inventory and report their inventory, value their inventory using FIFO or using LIFO. It really just depends on the company and the estimations and the decisions that they've made, their appetite for risk, their appetite for tax liabilities, that kind of thing. And everybody's appetite for that is fairly low, right? Nobody really wants to be paying much taxes. So, but if a company does want to choose to reflect the flow of inventory in their valuation, then they may choose FIFO because it just makes the most sense, right? We've talked about that. Told you guys, when you see people at Walmart pulling the things forward on the shelves, when they're stocking shelves, you see them putting, they should be anyways, putting the newer items from the boxes and from the pallets, they're putting them behind the older goods, right? So it really does, it really is, FIFO is a reflection of the flow of inventory, okay? But really, they may choose it because of the reflection that it has on the financial statements, the impacts that it makes on their financial statements. So, like we said, this is just a refresher on this, but during periods of rising costs, okay, which for most companies is always, right? Things typically don't get cheaper over time. The cost to purchase inventory, the cost to purchase raw materials increases over time. So FIFO is going to result in the higher ending inventory, which is a higher asset account for them, right? It makes their balance sheet look a little better. It's a lower cost of goods sold, which is a decrease in an expense for them. Okay, so it makes their net income look higher, which you see here and reported in your gross profit, right? So you're going to have a higher gross profit, which in turn, if you follow that all the way down, leads to a higher net income, right? So, why would a company choose LIFO? Well, tax savings. You know, that's what we've talked about. The primary benefit for LIFO and the reason most companies choose to do it when they do report this way is that it results in the lowest amount of reported gross profit, which in turn reports a lower net income, right? And this is, you just got to be careful because this is when costs are rising. What happens if costs fall? What happens when things actually start decreasing in cost, right? Well, we'll talk about that later, but you can't just flip-flop between the two different methodologies. You have to kind of pick one and stick with it. And if you do decide to make a change from like FIFO to LIFO or LIFO to FIFO, you have to provide a good reason for it. The FASB is not going to just let you flip-flop. You have to pick for one and stick with it. And I do like this little point right here. Can a company have its cake and eat it too by using FIFO for financial reporting and LIFO on the tax return? Nope. It's an established rule in the IRC, the Internal Revenue Code, that the IRS, the Internal Revenue Service, establishes the LIFO conformity rule, right? So if a company uses LIFO for tax reporting to decrease their tax liability, right, their taxes payable, is essentially what this is saying. If you're using LIFO to decrease your taxes payable, then you've also got to use LIFO for your financial reporting. Okay, so yep, IRS nips that in the bud. I know we've talked several times about things that the IRS does to make sure that we have some conformity and that people are not, it's not just the Wild West, right? This is just to reiterate what I said a minute ago. You know, once a company chooses a method, it is not allowed to just flip-flop between one or the other. Now, this is not to say that they're not allowed at all. It just means you can't frequently change from one to another. Once you pick one, you've got to stick with it. Okay, you just got to stick with it, which is why this right here is so useful, right? You don't have to use the same method for all of your inventory. If you want to value your lettuce inventory at FIFO, that's fine, but you can do that. That's great. So let's say you have another type of inventory that you want to value at LIFO. Great. You just have to make a note about it. You have to tell them which inventory method is being used in your notes to the financial statements. This is the company's 10Ks, right? This is why we've hit those 10Ks so hard. If you remember back to the Chapter 5 10K example that we walked through in the video, this is what we were talking about. We looked at those notes to see when do they recognize revenue? What do they call these account names? You'll see the same thing here. We'll see how do they value their inventory? Which inventory is being valued with which method? Now, there are a lot of different ways to value inventory. We're talking about two of them here, the easiest two. Okay. So the next thing we got to start talking about is how do we maintain inventory records? How do we actually record these? Okay. So companies typically use one of two systems to track, to maintain. It assists them in their recording as well as their accounting. Okay. The first one is a perpetual inventory system. This is a continual record of inventory that you have on hand and any inventory that you purchased or sold, right? So again, your beginning inventory plus your purchases less any cost of goods sold, right? That's what this is. It is a perpetual, continual record of your cost of goods sold model. Okay, it really helps managers make really good decisions, kind of ad hoc. You can pull up a report and see where you're sitting right then and be able to make really good, timely decisions. This is most often what you will see used in practice. This is what a retailer like Walmart or Target or Amazon is using. They can tell you at any given moment, right, how much of a certain item that they have in stock. And typically this is linked up with some of their ordering systems so that when they start running low, they don't have a human making those ordering decisions. Now they've got computers doing it, right? So if you ever walk around Walmart or Target even, and you see them walking around with those little pads in their hand, that's what they're doing, right? That's tracking their inventory for them. So you can stop one of them and ask them, hey, what do you have any of this in stock and where's it at? Okay. The other one is a periodic inventory system. So perpetual meaning like always, constantly tracking, right? Periodic meaning occasionally tracking, right? That's all these mean, okay? It does not continually record inventory amounts, okay? It calculates it at the end of the period, okay, based on a physical count. So this is something that smaller businesses are going to do, right? If you only own one brick and mortar, okay, and it's small, you're probably going to just do a physical count at the end of the month for your inventory and make an order then, right? You do it at the end of the month and you do a physical count. Now, Walmart, even though they use a perpetual inventory system, usually it's a yearly physical count, and they don't do it themselves. They pay a third party to come in and do a physical inventory count for them, okay? But with this periodic system, it doesn't continually record inventory amounts. You make adjustments at the end of the period for purchases and sales of inventory. Okay, this video. All right, so let's take a look at a perpetual inventory system here and see exactly what we are talking about. Just follow the flow of inventory, okay? So here's your transactions again. Just remember, these are all the transactions that we've had. We've got our total cost of $10,000. We got total revenue of $12,000. Okay. So let's say on April 25th, we purchase inventory for $2,700, 300 units at $9 each. Remember, I told you guys, make sure you know your dates. Also now, when we're talking about inventory, we want to know our costs and the amounts. So how much, how many, and how much, right? That's what we're looking at here. So we bought 300 for $9 a piece. That's that $2,700 right there, okay? So there's no expense because we bought it on account, okay? No expense, not yet, right? But we're going to increase our inventory and we're going to increase our liability. This is the Chapter 3, right? This was your Chapter 3 entry, okay? So here is your journal entry for that. We're going to increase our inventory. That's an asset. And we're going to increase our liability right there, okay? Asset and liability, both increases. All right, so now let's say on July 17th, right, there's our date, July 17th, we sell inventory on account for $4,500. How many? 300. How much? $15 a piece, okay? So what's this tell us? Well, sales tells us we're going to have revenue. On account tells us we're going to have AR, right? We both got both of those things right here, okay? Also, it tells us we've sold something, so we're going to have a cost to that sale. That's your cost of goods sold. Okay. And we have decreased an inventory item. So that's your decreased inventory right there. Okay. So what are we going to do? Well, it involves a couple of different things here, right? We just talked about that. The first one, we're going to recognize that revenue. We're going to increase our AR and asset by $4,500. We're going to increase the sales revenue account for revenue by the same amount. The second thing we're going to do, right, so we're going to recognize the expense. Why are we recognizing an expense? Well, we're using up part of an asset. We're using up a resource. So we're going to do this assuming that we're using the FIFO method. Okay, so going from that beginning inventory, that first purchase. Remember, this is technically our first purchase. I said that way back, maybe in video number 1. Okay, so we're going to increase the cost of goods sold account by $2,500. We sold 300 of them, so 100 of them came from that first purchase. 200 come from the next purchase, totaling $2,500. Increase the COGS. This is an expense, right? And then we're going to decrease the inventory count and asset by that same, by $2,500, right? So same amount, increase COGS by 25, decrease inventory by 2,500. This is what the journal entry looks like. You can see here we're increasing an asset, we are increasing a revenue, we are increasing an expense, and we are decreasing an asset, okay? So, any questions about that transaction, please feel free to contact me and we will discuss it.